Now, everyone's heard of the autumn rally, that optimistic time when markets climb into year end. But is it real? And more importantly, is it tradable? In this video, we're going to dive into the hard seasonal data that Seasonax reveals to separate myth from reality and show you how to trade smarter. So, what is the autumn or year end rally? The autumn rally, sometimes called the year-end rally, is one of the most well-known seasonal stock market phenomena. It refers of a tendency for equity markets to rally in the final few months of the year, typically from late September or October through to the beginning or the end of December. Now, there's a few theories behind why this happens. Some point to institutional rebalancing after a quiet summer. Others cite the anticipation of strong fourth quarter earnings. You'll also hear arguments about increased holiday consumer spending, or maybe even the impact of lower trading volumes. So there's reasons given why the markets drift higher, but regardless of the explanation, the real question is, does the data back it up? Let's take a look. Well, when we dive into Seasonax, you can look at a whole range of different indices across the globe. And we do find strong evidence of this pattern in many key markets. For example, the leading 500 companies out of the US, the S&P 500, typically sees a strong period starting around early October over the last 25 years into year end. You can see there is a winning trade percentage of 80% and an average return of over 4%. The maximum gain has been 13.27%, and the losses have been relatively few, with only 1, 2, 3, 4, 5 losses in those 25 years. The Nasdaq has another strong bias for this seasonal pattern. You can see that it's a 76% winning trade percentage. Obviously, you've got the dot-com bubble year of 2000, where the pattern was hit particularly difficultly. But if you take that strong down year out with the dot-com bubble, you can see that it has still, even with that, allowing for the data, an average return of 3.71%. And we can actually take that data out, go to 2000, remove that data from the pattern, and you can see actually it's closer to an 80% winning trade percentage and an average return of 5.81%. And that seasonal pattern runs from early October into year end. Now, if you look at the DAX, you can see again another 80% winning trade percentage, average return of 6.21%, with that seasonal pattern just beginning early October into the year end, and a maximum gain of 16.78%. So again, a very strong seasonal pattern. If we look in Asia, the Nikkei also exhibits this autumn year-end rally strength, and from the end of October into year-end, got an average return of 4.47% and a winning trade percentage of 68% and maximum gains of 20.72%. So here's the key takeaway. The autumn rally does show up in multiple markets. However, the timing and the strength can vary depending on the region. There is a further plot twist to this seasonal pattern, and that is that not every market always has an autumn rally, and even when it does, not every year is equal. So for an example of not every year being equal, if you look at the S&P 500 over the last 97 years, we've already seen, yes, look, it has a strong year-end autumn rally bias, an average return of 2.42%. But there is a presidential cycle that impacts this seasonal pattern as well. And if we look at post-election years, and with the US election being in November last year, the current year, 2025, is a post-election year. So we are in a post-election year. And if we click on Seasonax's feature here to filter just those post-election years, we can straight away see that the average return is much more modest, 1.61%. Why is this? It's most likely because a new US administration is often marked by policy uncertainty, budget negotiations, can be interest rate adjustments, all of which can weigh on sentiment with that uncertainty heading in to year end. So while the year end rally is part of stock market common knowledge, blindly following it, you see, without checking the context, can lead you into trouble. So what's the main point here? The main point is that the autumn rally is a real pattern. But it's not a universal rule. Some markets follow it more closely than others. And some years you can see the bias can be heavily weakened, if not defied completely. That's why it's critical to follow the data and not just rely on, market myth or what everyone is saying. Instead, use data tools like Seasonax to go beyond the headlines and actually analyze the data. Which markets have that strong Q4 performance, which specific years, how external cycles like elections may disrupt the pattern. Because when you do that, you're moving from trading just a narrative to trading a statistical reality. So whether you're trading indices, sectors, or individual stocks, make sure to back up your Q4 trades with the hard data. Explore seasonal patterns here at Seasonax. You can sign up here and get access to literally thousands of seasonal patterns that are just waiting to be revealed. Remember, don't just trade it, but Seasonax it.